Julian, welcome to my show. Glad you can make it.
Thank you very much.
And
Glad
not only just a regular show, I'm an award-winning podcaster. I didn't know if you knew that.
I didn't know that.
I'm huge. I got it from the American Apartment Owners Association podcast, 2022 real estate podcaster of the year. Yeah.
Oh my gosh.
Oh yeah, man. What, Julia? You think I just have anybody on my show? I mean, you must have got through my vetting system very, very well.
Now I'm nervous. I wasn't before.
Good. That's what I like you. You're on the hot seat now, Vogel. Okay. So, I got to talk to you about, first off, the whole gist of what we're going to talk about is going to be deal structuring and capital structuring. And then we're going to talk about this Catalyst 3 fund, which I want to understand exactly how you've got that one structured, because it sounds, Julian, like you might be pushing the limits a little bit to the co-GP structure. And I want to understand how that all works. But first, let's talk about, what type of assets does Catalyst 3 get into?
Yeah, so Colony Hills Capital, right? That's the company that I'm the fund manager for. All we do is multifamily real estate.
Okay.
Is value add multifamily.
Okay.
We've been doing that since 2008.
Okay, so where do you 2008. So you guys came in right at the bottom?
The company started as a family office venture for Glenn Hansen, and he started the company 2 months before the crash.
2 months before? Good timing.
Yeah, and then we bought our first deal in 2011.
Oh, it took you that long, huh?
Yes. So, but since 2011, we've done 36 deals, 1.2 billion in total capitalization, a little over 12,000 units. And then on deals we've gone full cycle on, of which there have been 16.
Okay.
We've had an average levered IRR of 36%.
Nice. Okay. Well, and obviously you've been in it during a very, very good time.
Yeah. Oh yeah.
What do you see coming up in the next couple of years?
So I don't think anyone really knows, right? Because there's.
Oh, I do. I'm just not going to tell you.
Yeah, I think there's ample political risk and unknowns, but I think from a housing standpoint, everyone always needs a place to live and to sleep. And
there will be no political unknowns if Robert F. Kennedy Jr. becomes the president. He's going to disclose everything. He said, yeah.
Interesting.
Good luck to him. But anyway, so
so I think there's a lot of pressure on the feds to bring rates down. I think that's going to happen in the next 6 to 12 months. I think it'll happen incrementally. I don't think it's going to be all of a sudden. Cap rates typically follow interest rates. So I think values will eventually come back up. And what's been interesting in the last 6 months, and I think will be interesting the next 6 months, is seller expectations have finally been managed as far as where values are and where they can actually sell deals. Not as much as buyers want, but definitely more so than 6 months ago. And
I think that's going to increase. As these notes begin to mature, some of these sellers are going to have to get a big wake up call.
Yeah.
So
that's right.
Now, where are you guys in the process? Do you take the lead on these deals, or are you coming to the table for some other sponsor, or how does it work?
No, we're owner operators.
Oh, you are. Oh, you are. Okay. Yeah. So
we usually bring in an institutional JV partner on each deal.
Is that how you fill the capital stack?
Yeah. So the typical capital, we're using agency fixed rate debt on each deal, and then 60 to 80% of the equity is coming from some institutional partner, and then the GP equity is coming from a split between Colony Hills Capital's principals and employees, and then our Catalyst Real Estate Fund 3 is a co-GP fund, so it invests alongside us into the GP, and it's passive, so it's it's outsized returns. 20 to 25% net IRR to our fund investors.
Yeah. Now, what about what type of assets? You say value add, but are you guys going up, pick up, solid B value add? Maybe are you looking at C class value add? And what locations are you buying in?
We used to look at C deals, but now it's more like B minus to A minus, and we're buying up and down the Northeast and also Southeast. We did a lot of Southeastern deals, Atlanta, Florida, Alabama, in the beginnings of our company, and up until I'd say 2 or 3 years ago. But now it's been completely discovered, and nothing really makes sense from a price standpoint, especially in Florida. And then you also have insurance, clobbering a lot of the deals in the Southeast. And then Texas.
I run a brokerage and insurance, investment property risk advisors, along with my law firm and my consulting practice. And I got to tell you, I mean, some of these people that were like, oh, I think Houston's the greatest place in the world. You can't buy insurance down there. There's like one company, and they control everything. Mm-hmm. So it's fascinating that how the insurance market is screwing everything up right now.
Yeah. Well, you mentioned Houston. Also, the tax reassessments are insane.
Oh, really? Is that what's going on down there now too? Oh,
yeah.
Wow.
So we're not touching really the Southeast or Texas right now. We own a good amount in Houston and in Atlanta, but we've actually been turned on to Jersey, Southern Connecticut, and the Midwest, in particular Ohio.
You guys going to
markets that we like.
You guys going to places where everybody's leaving, Connecticut and New Jersey, for crying out loud. Wow.
There's still rental growth. There's still rental growth there. And a lot of the migration out of Manhattan wasn't just to Florida. People moved to Jersey, Southern Connecticut, Long Island,
Now, where are you located?
I'm in Western Mass.
Oh, are you really? Where?
Long Meadow, Massachusetts.
Oh, okay. Oh, all right. Yeah. Are you up in one of those nice, big, beautiful homes up in the rich section of Long Meadow?
I am in a rich section of Long Meadow, and my house is not, big. It's a nice house. I like my house.
Yeah. No, I used to do a lot of work in Springfield back in my old days, and I used to drive through Long Meadow. It's beautiful homes there.
Yeah, it is. I grew up in Springfield.
Oh, in Springfield you did? Okay.
Yeah, I grew up in Forest Park.
You got to be from somewhere, they say, Julian.
Yeah.
I guess you chose Springfield. So, yeah. I raised my kids in Duxbury, so that was that's we were in the same state.
Oh, cool. Are you in Boston now?
No, I got the hell out of Massachusetts, and I'm up in New Hampshire now. Live free or die state, and that's where I planted my flag. So
our CEO has a house on Lake Winnipesaukee.
Oh, really? What town do you know?
No. You
don't know? Okay. Yeah, I love that place. So that's very cool. All right, so let's get back to this fund. Now, this fund is let me see if I can find the where are you? Oh, come on, where's your fund information? Here it is. Okay. Now, it's a GP investment strategy. Okay. Now, you mentioned earlier that there was a JV component to it with these institutional investors, and it invests alongside the colony's principals and employees into the GP stance on a deal-by-deal basis. And this allows for investors to passively earn GP level returns without having to do any of the dirty work. And doesn't that kind of can get a little concerning with the SEC and the fact that the GPs all have to really provide some level of service?
Well, the fund is really an LP in the GP stance.
Okay.
So the fund's not signing on any carve-out guarantees. It's not responsible for any day-to-days, obviously. So the fund is a limited partnership filled with high net worth investors who are passive, and then we, as the manager of the fund, we place the liquidity in the fund into our own deals alongside us into the GP. We also source the JV equity, and the GP gets promoted. It gets a disproportionate share of the upside based off of the waterfall structure, right? That we formulate with our JV partner when the deal sells. And we're holding these deals for 2 to 3 years. They're value add, off-market deals. Yeah. Yeah.
Wow. Okay. So, let me ask you this. When you're doing a value add and you're going to hold it for 2 to 3 years, when you go to sell it, is your strategy to leave some meat on the bone for the next investor?
It depends. Usually not. Usually our buyer is an institutional group who wants a turnkey asset.
Okay.
We've basically extracted all the value. I'd say the only time that we haven't done that is if, like in 2021, right, where interest rates were sub 4% and cap rates were around the same. And so we could sell deals, when they were 75% through their value add strategy, still get a great, value,
Yeah.
and then just sell the dream. But these days, all the deals we own and are buying, we're assuming we're going to take it through the full, cycle and then sell a coupon clipper to an institution,
Okay.
a turnkey deal.
Okay. So what about you mentioned that you kind of got a little too rich for your blood around 2018 to 2019. Did you guys really start to slow down on your acquisition?
We did a ton of volume from 2019 to 2022.
You did.
We did 640 million worth in that time period.
That's great.
Yeah.
That's rich. Okay, so let's talk the rest of the show. Here's what I want you to teach us about your acquisition, not the acquisition, but the deal structure that you use. You mentioned waterfalls. You mentioned, you structure these waterfalls in conjunction with your JVs. How does that all happen? And obviously this Catalyst Fund, I guess what I'm not understanding is you talk about these JVs as if they're on a deal for deal basis, but you've got a fund. So does the fund raise the money to go into these deals one by one, or is the fund acquiring all these properties in one fund, and then you've just got different JV owners? How does that all work?
Yeah, sure. So a typical fund, let's start with what's typical, right? Which is often where people get confused with this concept. A typical fund is a large, 50 to $500 million LP fund, right? Which will represent 100% of the equity in a deal, right? And then the fund manager will be a group like us who runs the deal and then has some sort of carried interest or promote after usually like, an 8% IRR, something like that, right? 20 over an 8. That's a typical fund. Okay, that's not what we have. What we have is in the co-GP fund is we still have a fund which is filled with passive investors, just like a usual LP fund, but the strategy is different. The strategy is the money, the liquidity is placed into the GP stance on a deal by deal basis passively. We go out and on each deal, we have a network of institutional JV partners that are institutional LP funds or family offices or private equity firms. And they're set up to just allocate capital passively with operators like us on a deal by deal basis. And they provide the lion's share of the equity. So if there's $10 million, right, our deal sizes range from 25 to 130 million, right? But use an easy example. Let's say there's $10 million of acquired equity for a deal, not including the debt. Our JV partner will bring in $6 to $8 million bucks. And then the other $4 to $2 million is the GP equity. And we'll split that requirement with our fund and us. So that's where our skin in the game is.
Okay.
So now we got the fund and us sitting in the GP together. The fund is passive. It's just, passive just as the JV partner is.
Right.
We're running the show. And then before acquisition, we forge an agreement with the JV partner that says, hey, the cash flow from the operating cash flow, available cash flow is split. Let's say pro rata, or maybe you get a priority return to 7 or an 8%, right? This is to the JV partner.
Yeah.
And then we get the next 8 or 7 or the next pro rata share of the cash flow. And then on sale, we have a waterfall agreement, right? They get that it's a pro rata split until they hit let's say an 8 IRR. And then we get a promote. So now let's say they put in 8 million initially, we put 2 million, so we're at 20%. So our 20% increases to 30%, their 80% goes down to 70% until they hit a 11 IRR, right? This is all happening instantaneously on sale. Once they hit that 11 IRR, maybe we get another promote. We go from 30 to a 40% share, and they go down from a 70 to a 60, right? And then that's the way it's split for the remainder of the proceeds. Now we get 40% of the upside when we only put in 20% into the deal, and they get 60% of the upside when they put in 80%. But the reason why they agree to that, obviously, is because they were passive. They weren't doing any of the work we were, and we sold for a success. Now the fund, right? All of that promoted interest, right? All that juicy upside, the disproportionate share that I just described, that all gets split between the fund and us as the GP member. And all that disproportionate upside that goes into the fund then is split up amongst the fund investors. And so that's how we are promoting, this 20 to 25% net IRR to the fund, to the GP fund.
And that goes to pay for the big fancy homes in Longmeadow, Massachusetts.
Well, if if they live in Longmeadow and they've invested in the fund, I guess.
Good answer. Yeah, but wait a minute. You did mention something that I thought was kind of interesting. It's kind of an employee owned fund to a certain extent, right?
Well, the fund, once again, the GP member is made up of two parties, right, on each deal. Party number one is the fund, which is a bunch of passive investors, right? High net worth investors that we manage that fund. And the second GP member in each deal is Colony Hills principals and employees. We're not invested in the fund. We're invested into the deal on the GP level alongside the fund.
Oh,
alongside it.
Oh, okay. That's interesting. Now, on that LP side, do you try to have just one entity as an LP?
Yes.
So you're just dealing with, so somebody comes to you and says, hey, I'm a family office. I want to invest in your deal. So what have you got going on? Oh, we're looking at this, 200 unit apartment complex down in Bergen County. And, we think we're going to buy this one. Okay, great. I want to talk to you about that one when you're ready to set it up. But at the same time, you might have another family office that also wants to get in on that Bergen County. Do you like that? Do they bid against each other?
Back in the day, meaning 2021, early 22, I would have, on some deals, I'd have 3 to 5 term sheets from JV partners. And then it would just be like, hey, this is what I'm getting here. Can you do better on whatever split you're offering? These days, where most of the JV equity has kind of gone into their shell, are not participating, or transformed into pref equity. We've had 1 or 2 programmatic partners that we typically go to that are still active. And, we like them, they like us. We've done 3 or 4 deals with them. And so they've said yes to basically most of our deals in the last 18 months, let's say.
Okay. All right. So hold on 1 second. Hold on. Let me just, Julian, what about, you described the waterfall concept, and then just recently you just said about the pref equity. All right. Now you're doing value add type of deals. So it just drives me crazy when I see some of these, brand new syndicators out there doing value add deals, and they're offering a 9% preferred return on day one. Like every month they're going to pay 9%. It's a value add. Don't give me that money back. Put it back in the property. Make this thing turn as fast as you possibly can. So it sounds as though the first structure that you described, that works out great, because those guys are just in it for the long haul. They want to get, those hit those waterfalls. You guys want to hit your numbers as well, so you can take on more equity. You just mentioned that some of these guys are now looking at pref equity. How does that impact your model? How does that, what do you do with pref equity on a value add deal? Are you putting it all in the back end, or how does that work?
So I think right now I'm happy that all these groups are not participating, because right now is, like I was saying in the beginning of our call, a really good time to buy, because we're getting cap rates that are attractive. So if we're able to buy, if your listeners know what neutral to positive leverage is, I'll take a second to explain that. Neutral to positive leverage means that if I can borrow at a 6% interest rate, I want to make sure that my cap rate going in is 6% or higher.
Right.
Right? That's neutral to positive leverage. That means I'm making more money on yield than I'm paying in debt service to the lender. It's a really good way to audit the health of a deal and its cash flow. If to boot, there's also value add, dormant value add, meaning money being left on the table in this deal. Not only do you have strong cash flow going in, but you also have strong cash flow that's waiting to be unearthed in the property.
Right.
So when we use pref equity, which we've seldom done these days, there's usually enough cash flow to satisfy the pref equity group and then throw off a little bit of cash flow to our position, usually the tail end of year one, beginning of year two. And then as we keep, moving forward with our value add execution, the cash flow grows. And then there's organic cash flow that satisfies our pref equity and satisfies the GP equity or the common equity. So I wouldn't use pref equity if I'm looking at a deal that's, doesn't have strong cash flow. It just wouldn't really make a lot of sense. It's pretty risky.
Okay, so no negative leverage is what you're saying?
Yeah.
No, even if it has a strong, because I was talking to a mortgage, obviously was a mortgage banker, so of course he's going to sell you anything. But he was saying that he's willing to do deals that with negative leverage because of that value add component that leaving the money on the table, the dormant value add, as you just called it, which is an interesting term.
Well, I guess it depends on how much there is, right? If it's grossly mismanaged deal and they're leaving, $300 to $500 of loss to lease or premium on the table.
Yeah.
And they just, it has to be, the ship has to be righted, right? And they have to put in the necessary renovations and then improve the units and increase the rents. Then I guess you stomach some negative leverage. But if it's 90+% occupied and the premiums you're going to be targeting, the loss to lease you're going to be capturing is like, $100, $150 per month, then you really shouldn't be buying negative leverage. You should be buying neutral to positive leverage on a deal.
Yeah, I agree. So, all right. So what are you looking for now? Like who's your best customer? Like, what do you do on a daily basis? Are you dialing for dollars, Julian, just like the old days?
I used to dial for dollars. So my background, I used to live in Manhattan and I worked over the GW in New Jersey. And I worked for a top 15 mortgage brokerage, commercial mortgage brokerage. It was called Deerwood Capital. And then it was bought by Walker and Dunlop. And we used to do.
Wait, what year were they bought? Do you remember?
They were bought in 2018.
18, yeah. I mean, Walker and Dunlop was buying everything.
Yeah.
As a matter of fact, I have another podcast that I have right after you. Mark Rutson, he owned Enodo. That was his company. It was a data firm, and Walker and Dunlop went in there and bought him.
Yeah,
and I love Walker and Dunlop. I think Walker and Dunlop was one of the best commercial brokerage DUS lenders out there, and of course, one of my best podcasts was with Ivy Zellman. Do you know Ivy?
No.
Oh my gosh. Zellman and Associates, you should check them out. Watch, because usually Willie Walker and Ivy do like at least a month or
now his name's ringing a bell.
Yeah.
Okay. Now when you just mentioned Willie Walker and Ivy, now I've seen it. I get their solicitations.
Wow,
we use them for all of our debt. So I used to do that, and then I have my own company as a lone wolf doing the same thing, brokering debt and equity on all different types of CRE, multifamily, all across the country. Took my wife and 2 kids and moved back to Western Massachusetts. And then shortly after moving back here, I was introduced to Colony Hills Capital. And I kind of got tired of the feast and famine of living on commission.
Yeah.
But I was able to bring that experience to Colony. I've almost been here for 5 years. So they tapped me to launch a fund for them, even though I'd never done it before. And they also said, hey, why don't you run, our sourcing of and structuring of the debt and equity on a deal by deal basis. So I kind of wear 2 hats. So I'm talking on a daily basis. I'm talking to retail investors. I'm also talking to institutional, or private equity investment shops who are focused on deals. I'm also talking to fund of funds, institutional fund of funds that invest into funds. And I'm structuring the equity and the debt on a deal by deal, depending on what the characteristics of the deal is and what it needs. And then also determining the fund strategies. Our past 3 funds have been the same strategy, co-GP, capital.
So that was your structured? Is that what you brought to the table?
Yeah. So the first year I was with Colony, I would sit down with endowments, institutions, private equity firms to invest into an LP fund, $150 million LP fund that we were trying to launch. They would say to me, "We like your strategy, we like your track record," because we had a track record at the time, but it wasn't as robust as it is now. But they said, as far as a fund, you guys are an emerging manager, right? This is your first time fund. So come back to us when you're on fund 3 or fund 4 and you have some realized returns and a track record in the fund space that you can show for yourself. After hearing that for a year, I was like, okay, these guys see us as risky. So with investments, if there's risk, you have to have adjusted returns, right? There has to be improved returns. So where can we take in a regular deal? Where can we provide investors with juicier returns if they perceive us as risky? The promote, the GP. So it kind of hit me like a lightning bolt. I was eating like a deli sandwich at the office, and I was like,
"You weren't in the shower? You weren't in the shower, Julian?"
I wasn't in the shower. No, it was a deli sandwich. I remember I was sitting by myself in the boardroom eating, and I was like thinking this through. And then it evolved. It developed.
That is so cool. I love that.
It raised very quickly. It raised very fast.
I love. Oh gosh, I just want to tell the editor or the producer of my podcast, grab that last segment. That is it right there in a nutshell. That is really cool. Because a lot of new syndicators, they don't understand that. What you just said, they don't understand that, and they need to realize that, hey, I got a risky product to sell, and I've got to build insurance into that risk.
Yes.
And how do I do that? And you just described exactly how to do that. That's so cool. Good for you.
Yeah. Awesome. Yeah. Thank you very much. Yeah. I have noticed a lot of co-GP funds and GP funds popping up recently, though. The real estate industry is small, and word travels quickly. I'm not saying that we invented it, but
oh no, definitely. As a matter of fact, while you were explaining it, I just trademarked it, so it's actually mine now, Julian. You said that's how fast stuff works.
All right. Yeah. I guess I have to pay you some royalties or something.
Yes, exactly. Yeah, keep talking. I'm making a kill right now. Yeah.
Yeah.
No, that's awesome. And this is all for folks listening. If you want to check this out, you want to find out more about Julian, it's colonyhillscapital.com. And that is that's really interesting. I like that. Because everything is sales and marketing. And what you did is you just figured out what's my sales pitch for my product, because where I am. Now the question then becomes, you're now able to go back to those guys. You're now in your 3rd fund. You can go back to those people and say, hey, check out my track record. And do you need to continue to offer that type of a waterfall?
Yeah, good question. So until we start to have exits of our fund 1 and fund 2, so we've had one exit fund. So fund 1 was a $20 million fund. It was sprinkled over 7 deals, $380 million worth of real estate. And we sold our first deal in that fund December of 2022. And it was a 48 IRR and a 3.5x multiple for the fund. We have 6 more deals, though, in that fund that are all in varying stages of value add. And same thing for fund 2. So really what has to happen is we have to exit our first fund and show some really sexy or attractive returns to then launch a $150 to $250 million LP fund and say, hey, look what we were able to do. You can trust us, kind of thing.
Let me ask you this. This is all cool. Everything you and I have been talking about is pretty much at the 60,000 foot level, the real sexy side. How do you guys manage your properties from where you are all over the country to get these types of returns? Do you own the property management company? Do you just have people in your office, up here that are overseeing the property management firms that you've hired? How does that work for you?
Yeah, so good question. We have an asset management team. We use third-party property management. So we're headquartered in Western Mass, in Wilbraham, Massachusetts. I'm 20 minutes from the office. We have team members in New Jersey, Virginia, Houston, Texas, Florida, Boston. We've gone hybrid since COVID, and it's been wonderful actually because it's opened up, the employee pool. But basically, some deals we have the same third-party property manager the whole deal, and then other deals they fall on their faces, and we have to fire them, and we have to hire a new management company. And we manage the CapEx process. Our asset managers are at the property usually bi-weekly for the first year, first 6 to 8 months of ownership. So we're managing the managers. We've thought about being vertically integrated, meaning having our own management company. The reasons why we haven't are basically twofold. It's not as profitable. And second, it's prohibitive. It prevents us from entering a new market, oftentimes where we don't have an employee base, right? So unless we have like Houston and Atlanta, we could probably start our own management because we have 4 deals in Houston. We have 2 or 3
critical mass.
Atlanta. Exactly. But if we wanted to buy a deal, and we're looking at a deal in Columbus, Ohio, which would be, our first deal there, we have to use third-party property management. So there's pros and cons. The pros is the world is our oyster. The cons are that we don't own the process as much as we'd like to. But that's solved for by having talented asset management and really, people who are really 2 hands on the steering wheel and focused on what's happening.
Wow, very cool.
But I'm not going to lie to you, the past year and a half has been probably the rockiest phase of Colony's lifespan. And also, I'm sure of a lot of sponsors, right? Any sponsor that's been around for the last decade, since April 2022 until now, has probably been the most challenging phase, I think, for any of these sponsors, tenure in the last decade. And that's because a lot of people were using floating rate debt in 2020, 2021, right? Maybe they weren't buying rate caps on those deals if their lenders were stupid enough to not require it because they just thought, interest rates are never gonna go up.
I'm going to remain zero forever.
Yeah, right. And then you have insurance skyrocketing, and then depending on the market, you had tax reassessments, and then inflation for construction costs. So a lot of deals just got totally slammed, and I think right now is really gonna separate the boys from the men as far as skill.
That was a very sexist statement there, Julian. I just want you to know.
Well, okay, the girls from the women.
Oh my gosh, there you go. Oh my God, you can't get out of your own way, can you?
Whatever you prefer. So yeah, I think that, and it's honestly for us, we have 8 deals right now that require a lot of attention and focus. That deals that had floating rate debt on them that are, we're having to give a lot of attention to. Okay, the interesting thing I was going to say before to you when you asked about the future, right? And we were talking about interest rates. The cool thing that's happening in our portfolio and that we're still seeing is rental growth. Our whole portfolio is 11% higher in rental growth than what we estimated pre-acquisition on some of these deals 1 to 2 years ago. So the income side of the equation is still really solid.
Okay, so let me ask you something, because I've heard about, which markets are really starting to slow down on the rental growth, and then mostly secondary and tertiary markets where, you don't see that type of growth anyway. Are you saying that the majority of your properties are in more of the primary markets?
Yeah, we own, for the 4 deals I just mentioned in Houston, they're in kind of like, if you take Houston's CBD Houston, we own in like this quadrant, like the northwest to west, where there's high income.
Yep.
And so that's typically how we're approaching our deals anyways. We're taking a top-down approach. What's the average median incomes? What's the crime? What's the
Yeah.
industry? We're looking for incomes that are north of 100K on average per household. And then usually, that means there's demand there, either because there's schooling or there's jobs. And so if there's demand, that means there's rental growth.
I thought you were going when we were talking about property management. Then you pivoted and you said this is one of the most challenging times coming up. I thought you were going to start talking about how labor has been an issue, meaning that now recently you've had more trouble with your property management companies because you can't get the labor or the labor costs are so high. I thought that's what you were going to say. Have you seen that as an issue?
I would say no, but that's probably a better question for our asset management team. And we have a 3.5 hour company-wide meeting every Monday morning. So I get updated, on the assets, but more on a superficial level. But they probably know more, but I haven't heard that come up. I haven't heard like, hey, there's this crazy turnover at, our management companies.
Yeah, we can't find people to fix
Right.
their stuff or anything. Okay.
Right.
Now, so are you saying that your company, you guys were kind of enticed by the sexy, floating rate interest rates on
Yeah.
Oh, really?
Yeah.
Okay.
So we bought I guess the difference between us and others did as well. I'm not trying to say we're the only ones. We bought, 3 or 4 year rate caps that were, 2 to 2.5%. So our, maximum we paid on our deals is, 6 to 6.5% interest rates. So it's still much higher than our pro formas and what we were forecasting for these deals pre-acquisition, but they're not high enough where it's like just sinking the ship.
Okay. And yeah, so I guess you guys had enough spread in there and the fact that your strategy was short-term hold value add 2 to 3 years, you figure like we don't need to get a fixed rate interest rate.
Yeah. Well, I don't know how many people were actually using, long-term fixed debt to buy deals in 2020, 2021.
Yeah, I know. It's interesting because I had one guy who's a fantastic owner operator. He was buying long-term loans at fixed rates because he didn't want the risk. He didn't want the risk. And then there was another guy who was on my podcast. Nice guy. And, I think he started in the business the same time I did. And he's done fabulously well, or so it seemed. And his strategy was interest only for the entire term of the loan, floating rate interest. Okay. Somebody sent me a YouTube video that he had put up there meant for his investors, basically saying, we're doing our best. We're in default on this. And I tell you something, Julian, I was in the business before you guys were. And I remember what it was like when you were losing your property because rates are going up, maturity defaults, cap rates are rising. And I looked at this guy's face and I just thought, oh man, buddy, my heart breaks for you because I've been through that. I can see it in your eyes. He's scared. And he lost a $55 million portfolio. Yeah. Wow. So it was tough, but I know.
It's funny because I don't know why there wasn't more common sense in our company and in the industry that if the government was pumping out money, inflation was inevitable, and the only way you combat inflation is raising interest rates. So I don't know why we didn't have that thought process. It's kind of like the hindsight is 2020, right? But it seems just so obvious now. Looking back.
I know, and I heard it killed Charlie Munger. I heard the stresses kill. You know what? Is it too soon? No, is it too soon? No.
I don't know. I'm laughing. So it's fine.
Okay, good. Yeah, I don't think it's too soon. I don't think any time is too soon. So, Hey, Julian, you've been a great guest. You've been a lot of fun, and
Yeah, you too.
I really enjoy talking with you. So, best of luck to you. I want people. I'm going to say it again. It'll be in the show notes. ColonyHillsCapital.com. Check it out, folks. And that one snippet that Julian talked about with how to sell your fund. If you're brand new, it's risky, how do you convince investors to come with you? Julian has figured it out, and he's got it. Well, he used to have it trademarked until I came along.
Thank you.
All right, Julian, great to see you, man, and we will talk soon.
Yeah, you too. Thanks.
Take care. Bye-bye.